For more on the broader markets, we want to bring in Keith Lerner. He is a chief market strategist at Truist. And Keith, yesterday was dominated in part by China and also some Fed speak, and that's really what I want to concentrate on. We have a key Fed meeting up in a couple of weeks, and looking like it's probably going to be 50 basis points, but lots of other nuance, shall we say, surrounding the event. Just wondering what you're expecting.
Yeah, well, first, Jared, great to be with you and Dave today. You know, with the Fed, obviously a lot of anticipation about what's coming out of this meeting, but I would say this. We've had a rally partly on the hope of a Fed pause or a pivot, but I think the bigger picture as we move into 2023 is that the market's narrative, in our view, is likely to shift. It's going to be a shift from, this high inflation to concerns about economic growth, and we are expecting to see some easing in inflation, but that keeps us somewhat defensive because the concerns about the economy. And as far as Fed speak, the data is slowing down when we look at inflation. Now, they're not going to go ahead and discuss that slowdown too much because they're going to continue to emphasize inflation until they are really confident that it's behind us. So it'll be premature to say that, but I think inflation trends are certainly weakening as we look around the globe.
You talk about those big picture economic concerns. How concerned are you about a potential recession this year into next? Bank of America CEO Brian Moynihan saying he thinks we could avoid it. Worst case scenario being a brief and mild recession. Your thoughts, Keith?
Well, I mean, listen, I think there's a narrow path to avoid a recession. Our base case is that there more likely will be a recession. And we look at the way the evidence, right? There's no crystal ball on these things, but look at the LEI on a year-over-year basis. It's below 2.5%. You've never seen that without a recession. Historically, that's come within 5 months. You have the deepest inversion of the yield curve, the 10-2 curve, now the 10-3 3-month curve as well. Jared mentioned earlier about housing. Housing tends to peak well above recession. And we also have had the most aggressive global central bank tightening we've seen in about 40 years. We think that weighs on the economy. And then to your other question about short and shallow, I think that makes sense as a base case. I think that's a knee-jerk reaction, right? Because the consumer's in good shape, the labor market's in good shape. The only thing I will say, if something from left field comes or an outlier event, think about what happened with Ukraine this year, there's going to be less policy response from both the Fed and also the fiscal side, especially where debt is today. So I think, again, it makes sense to have somewhat of a short and shallow, but I think investors should also be thinking, what can make it different? And again, I think the lack of or some restraint around policy responses could make things a little bit deeper and longer if something unexpectedly happens from left field.
And Keith, as we wrap the month of November here in another day and we head into December, we're in that seasonally bullish period of the year. Of course, no guarantees. Maybe accounts for about 1/3 of a potential tailwind. Just wondering, what do you see as potential upside here? Are you buying it, and what are you buying?
We are actually, we've been using this strength actually to reduce risk. We've gone overweight fixed income for the first time over the last decade because we think the upside in the market is likely capped around 4 to 5% at the headline index. And you can look at the 2-year high quality fixed income, keeping it simple, you can get yields around 4%. So we just don't think if we're heading into a recession, if the range of outcomes are wide, we think there's more value in fixed income. I would say, Jared, you kind of hit on this in the segment before. I think there's more value underneath the surface. We're underweight technology, we're underweight communication services. We like things like energy, industrials, healthcare, and the equal-weighted S&P we think is more value. That just hit a 3.5-year relative high today. So you have to be more selective below the surface, and that's our strategy as we head into 2023.
Have we seen a bottom yet, Keith?
It's a good question. I don't know if we can say that definitively, and I don't think that you need to say it definitively to say that even if we go just back and retest, there's a lot more downside relative to the upside in the market today. As far as whether we've hit a bottom or not, you had sentiment that was at an extreme around the lows, but the one thing you really didn't have is extreme in valuations at that point. And historically, the market has never bottomed before a recession even started. So again, I mean, I don't know what probability to put on it. I would say maybe at least 50% that we break below it. But again, I think the risk reward, regardless of that, is somewhat less favorable, at least on a short-term basis for the equity market today.
And Keith, you mentioned some of the sectors that you like here: energy, industrials, healthcare, consumer staples. Anything within there that you'd care to expand on? I've noticed biotech really picked up earlier in the year, almost ahead of the entire healthcare sector. Maybe look into some industry groups. What's the reasoning behind these sectors that you like?
Yeah, it's kind of interesting because normally if our base case is recession, we wouldn't be overweight industrials or energy. But let's talk with the industrial sector as an example. There's some unique things happening there. One, they're benefiting from the reshoring. Also, the stimulus bill that was passed earlier this year has infrastructure spending. And then really what's been standing out within industrials is the defense area, right? And if we are in this, higher geopolitical uncertainty period, and you're seeing defense spending, especially in Europe, move up, we think that's a secular tailwind for that sector as well. I mean, healthcare and staples is more of a defensive view in a choppy market that we can expect to continue. And then going to energy, we've been overweight that sector since early 2021. A lot of discussion today about China reopening. That's also, if the global economy proves to be somewhat stronger than we're expecting, that's a good hedge because you'll start to see oil prices better supported after the pullback that we've seen here more recently.
And as related to the news out of China, do you just, Keith, put your earmuffs on there? It's difficult to know minute to minute whether we are reopening, going back into lockdown. Disney Shanghai closed yet again. What do you make of all of the noise?
Yeah, overall, we're still negative on emerging markets. I think they were deeply oversold ahead of this news. They got really beat up, and we're seeing a kind of a mean reversion bounce. So listen, we're open-minded to see if the earning trends actually change. But I think even if they reopen, it's going to be a long and volatile process, right? I mean, especially how large that population is, and there's dispersion among the different regions as a whole. So I think people aren't positioned for this. The bounce likely has further to go, but we're still skeptical at this point.
And Keith, wanted to ask you about the dollar here. The Dixie bouncing off its 200-day moving average. It's heavily weighted, that particular index, towards the euro. But you look overall, it's been a year of the dollar, although it's come back. And the reason I bring it up, I'm just wondering if it were to bounce off this key technical level into year end or early next year, what does that do for your outlook, for your forecast for some of these risk markets we're talking about?
Well, when you think about investing globally, Jared, the U.S. dollar strength and U.S. outperformance relative to other markets tends to go hand in hand. And our baseline view is that the dollar will, remain somewhat strong. Obviously, we think it's going to, be somewhat more moderate than these huge gains we've seen over the last year. But we think, even though we expect the U.S. to be in recession, we still think we're in much better shape than the rest of the globe. I think Europe is still somewhat fragile as well. So again, maybe some moderation, maybe some sideways choppy action after this big move up, but we still think the dollar will be well bid, especially that rates are still somewhat higher here in the U.S. relative to what we're seeing in Europe and other areas of the globe.
All right, got to leave it there. Keith Lerner, Truist, good to see you, sir. Thank you.